Today, we're diving into the exciting world of investing in stocks. Whether you're looking to grow your wealth or simply curious about the stock market, you're in the right place. But before we jump in, don't forget to hit that subscribe button and ring the bell for notifications. Let's get started.
What's up, everybody? We are Investment IQ Insights, and today we're diving into the world of investing. Let's be honest, investing can seem pretty intimidating, especially if you're just starting out. There's so much jargon, so many different options, and it can feel like you need a finance degree just to understand the basics. But here's the truth. Investing doesn't have to be complicated. In fact, getting started with investing is easier than you might think. In this video, I'm going to break down the fundamentals of investing in stocks, giving you the knowledge and confidence to start building your own financial future. We'll cover everything from what the stock market is to how to choose your first investments. So buckle up, grab your notepad, and let's get started. The stock market is basically a giant marketplace where you can buy and sell pieces of companies called stocks. When you buy a stock, you're buying a small ownership stake in that company. The stock market allows companies to raise money to grow their businesses, and it allows investors to potentially profit from that growth. Common stocks represent ownership in a company and give you the right to vote on certain company matters. When you buy a common stock, you're essentially betting on the future success of that company. As the company grows and becomes more profitable, your stock's value could increase, allowing you to sell it for a profit. But remember, investing always comes with risks. Active investing involves frequent buying and selling of stocks based on market trends and analysis. Passive investing, on the other hand, takes a more hands-off approach. Passive investors typically invest in funds that track a specific market index, such as the S&P 500. This strategy requires less time and effort, making it ideal for beginners. Long-term investing involves holding on to stocks for years, even decades, to benefit from the long-term growth of the companies you invest in. Stock trading, however, focuses on short-term price fluctuations. Traders aim to buy low and sell high, capitalizing on market volatility. Trading can be risky and requires significant time and expertise, making it less suitable for novice investors. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They are managed by professional fund managers who make investment decisions on behalf of the fund's investors. Mutual funds offer instant diversification, which can help reduce risk, but they also come with fees. Index funds are a type of mutual fund that passively tracks a specific market index, such as the S&P 500. They aim to replicate the performance of the index rather than trying to beat it. Index funds are known for their low fees and simplicity, making them a popular choice for both beginner and experienced investors. ETFs, or exchange-traded funds, are similar to index funds in that they track a specific market index or basket of assets. However, ETFs are traded on stock exchanges, just like individual stocks. This means their prices fluctuate throughout the trading day, unlike mutual funds, which are priced only once per day. Many companies offer retirement plans, such as 401k plans, which allow you to contribute a portion of your pre-tax income to a retirement account. These plans often come with employer matching contributions, essentially free money. Taking advantage of your company's retirement plan is a great way to start investing early and benefit from the power of compound growth. Individual retirement accounts, or IRAs, offer tax advantages for retirement savings. Traditional IRAs offer tax-deductible contributions, while Roth IRAs allow for tax-free withdrawals in retirement. IRAs can hold a variety of investments, including stocks, bonds, and mutual funds. To start investing in stocks, you'll need to open a brokerage account. Brokerage accounts act as a gateway to the stock market, allowing you to buy and sell investments. When choosing a brokerage account, Consider factors such as fees, investment options, research tools, and customer support. For beginners, we recommend starting with low-cost index funds or ETFs that track broad market indices like the S&P 500. These funds offer instant diversification and are a great way to gain exposure to the overall stock market. As you gain more experience and knowledge, you can explore other investment options. Remember, investing is a marathon, not a sprint. It's about building wealth gradually over time, not getting rich quick. Focus on long-term growth and avoid making impulsive investment decisions based on short-term market fluctuations. By staying disciplined and investing consistently, you can increase your chances of achieving your financial goals. So there you have it, a beginner's guide to investing in stocks. Remember, investing doesn't have to be complicated. By understanding the basics and taking a disciplined approach, you can start building your financial future. Remember, the key is to start early, invest consistently, and stay focused on your long-term goals. We covered a lot of information today, and it's natural to feel a bit overwhelmed. Don't worry, take your time to digest everything we discussed, and remember, there are plenty of resources available to help you along the way. Please remember to like this video and subscribe to the channel for more insightful investment guides and tips.